Hi, this is Karthik and welcome to the 7th video in the mutual fund series. I hope the previous video gave you a good understanding of equity mutual funds. In this video, we'll explore debt mutual funds. Before we understand what debt mutual funds are, you need to understand the origin of debt. Let me take a simple example and help you understand what debt really means. Assume you aspire to buy an apartment worth 1.5 crores. You have 40 lakhs in your bank, which you can use to pay as down payment. You're short of 1.1 crores. Now, one of the most easiest way to fill the deficit is to take a loan. Let's assume you approach a bank to take this loan. Let's assume that the bank is willing to offer you this loan at 8.5% for a 10-year period. The first thing that the bank would do when you approach them for a loan is to check your credit worthiness and also check for your credit score. Assuming both of them are in place, the bank will be happy to give you that loan. So roughly, this is how the terms of your loan would look. Now obviously you will take this loan assuming you're okay with the terms. Now remember, from the bank's perspective, this is a collateralized loan. Your apartment is the collateral here. But does that mean the loan is completely safe for the bank? Let's put ourselves from the banker's perspective and evaluate all the risks involved in this loan. There is a cash flow risk here. What does this mean? This means that the borrower may skip his EMI or pay the EMI irregularly. There is a default risk here, meaning the borrower may completely default on his obligation to pay the loan. There is also an interest rate risk here, wherein the interest rate in the economy may change, leading to the change in the expected cash flow. There is also a credit rating risk here, meaning at the time of issuing the loan, the borrower enjoyed a very good credit score. What if the credit history starts to degrade? Finally, there is also an asset risk here. The loan is issued against the property. What if the price of the property itself starts to decrease? These are some of the most common risks associated with debt, and these risks are applicable to the entity issuing the loan. In this case, it happens to be the bank. Now let's modify this example. Instead of a person taking 1.5 crores from the bank to buy an apartment, let's assume it's a corporate entity wanting to borrow 1,000 crores to expand the business. Under such a circumstance, the company can approach a bank and borrow the entire amount, that's 1,000 crores, or the company can issue something called as a bond to the public and raise the money from several different investors. You and I as investors can participate in such bonds. For example, I could lend the company 10 lakhs out of the entire 1,000 crores and subscribe to the company's bond. Assuming the company pays an interest of 8.5%, then every year, as long as I hold the bond, I will get a cash flow of 85,000 per year. Of course, at the end of the tenure, I also expect my principal amount, that is 10 lakhs, to be returned back to me. In a nutshell, this is how a bond works. As a bondholder, you are entitled to receive periodical interest payments, also called coupon payments, and at the end of the bond's maturity, you also expect the principal to be returned back to you. Now you may wonder, what sort of risks are applicable to the bondholder? Well, the same set of risks that we discussed for the bank is also applicable to the bondholder. And the risks include credit risk, default risk, and also the interest rate risk. So at this point, I want to emphasize a few things. Bonds are debt obligations issued by a company, or it could even be from the government. As opposed to the popular belief, bonds are not risk-free, they too carry risk. Although if it's a government-issued bond, that the fear of government defaulting is low. In other words, default risk for government-issued bonds is low. But that said, some of the governments have defaulted in the past. As of today, one of the biggest participants in the bond markets are asset management companies. AMCs collect money from the investors in the form of mutual fund schemes. They then, instead of investing this in equities, they invest in bonds issued by companies or government. These are called debt funds. So as you may have guessed, if you were to look at the portfolio of a debt mutual fund, you will find a lot of bonds issued by the government and private companies instead of stocks. There are roughly about 16 subcategories in debt mutual funds. I will not go through all of them in this video. I'll only talk about few that are important. But I would highly encourage you to read all the chapters related to debt funds on Varsity. The very first debt fund that I'd like to talk about is called the liquid fund. I would encourage you to read the SEBI circular to understand the formal guidelines. But broadly speaking, as per the SEBI circular, a liquid fund can only invest in debt funds which has a maximum maturity of 91 days. Consider a company wants to borrow 500 crores to meet its working capital requirement for a quarter. They can do so by issuing something called as a commercial paper. At the end of 91 days, against the commercial paper issued, the investor will not only get back the principal, but also an interest payment. So in the portfolio of a liquid fund, you will find a lot of commercial papers issued by companies and the government. By the way, if the government issues a commercial paper of sorts, it's not called a commercial paper, it's called a treasury bill. People choose to invest in a liquid fund to park excess funds which they intend to use sometime soon. By sometime soon, I mean 10 years within 365 days or a year. So think about the liquid fund as a parking space for the excess capital that you have, which has abundant liquidity and which you intend to use soon. People often treat a liquid fund as a proxy for a bank's deposit and assume it is completely safe. But it's not true. End of the day, a liquid fund contains commercial papers. Commercial papers are issued by corporate entities, and a corporate entity can always default on its obligation. In fact, in Feb 2017, the liquid fund belonging to Taurus Mutual Fund had invested significant amount in commercial paper issued by Ballarpur Industries. And as you may have guessed, Ballarpur Industries defaulted, and the investors in Taurus Mutual Fund's liquid fund lost a significant amount. Although this is a significantly rare event, you as an investor in a liquid fund should be aware of this. Now, for some of you new to finance, this may come to you as a surprise. Like how corporate entities and governments borrow for 91 days, they also borrow for overnight purposes. Yes, literally overnight, 24 hours. I will not get into the details of who borrows and why companies borrow for 24 hours. But please be aware that such borrowing does exist in the market. And this leads us to the next debt fund called the overnight fund, which is as popular as the liquid fund. And as you may have guessed, overnight funds invest in overnight bonds. In fact, the biggest advantage with an overnight fund is that the default risk is very low or non-existent. Of course, with the reduction in risk, the return too is greatly reduced. But that said, investors in overnight fund do not invest to chase returns. They invest mainly to park their surplus and protect their capital. And with this, I hope you've got a sense of the two most popular debt funds, basically the liquid fund and the overnight fund. So in the next video, I'll start with introducing two debt fund jargons and talk about few more debt funds. Do comment and let me know if you have any queries. I'll see you guys in the next video.